The following is for informational purposes only and is not financial advice. Please consult a professional before making any financial decisions. For your reference, our full disclaimer will be displayed at the end of the episode. The big aha is that the 401k was pretty much passing the burden of investing to you, because now the employer doesn't have to worry about growing your money so that you can retire comfortably. Now it's up to you, the individual, to be prudent and invest your money wisely so that you can have enough for retirement. Welcome to Building Wealth from Scratch podcast. My name is Jerry. I am a financial planner and co-founder of Confianza Wealth Management, alongside with my co-host and my wife, Bianca.
Hi, I'm Bianca. I'm a first-time wealth builder and co-founder of Confianza Wealth Management, and a wife and dog mom, and super excited to share my experiences of being a first-time wealth builder.
So why are we here? We're here because, as my wife mentioned, we are first-time wealth builders. And we've been in the industry, in the wealth management industry, for combined 10 years. And we quickly realized how little we knew about finance. Mm-hmm. And not only that, but the firms that we worked with only help high net worth and ultra high net worth individuals. So we figured, what about the people that don't have that income or that don't have that wealth and want to build that wealth, which is why we founded Confianza Wealth Management. So today we are recording our first ever episode. So super excited.
Yay.
And today's topic is investing. How do you start investing? So we have a ton of great questions that we're going to help answer. And with that, we'll send it off to you.
Yeah, so let's start with sharing a little bit more about how you started with investing, because there's a lot of people out there that want to basically start investing, but they don't know where to start. And they're like, now in 2025, it's becoming a lot more popular to, like get ahead, especially with this economy. Like, what are the ways that I can, really get ahead with my money? And so I think it'd be helpful to just learn a little bit more of like how you got into investing. So what are some things that you did and what did you learn? Just sharing more about your experience.
Yeah, definitely. For me, I feel like I started backwards. So normally when you start investing, you should start, small and with less risk. I actually started off as a day trader, trading futures contracts, which is very speculative and, pretty high risk. And so I quickly learned that, investing is important, because if your money is not growing with inflation or with the things around you, you're losing purchasing power. So that's how I got started. I was very intrigued because I knew so little. I didn't even know what an ETF or a stock was. And from there, my curiosity really led and paved the way to where I am today.
I think for first-time wealth builders, what is the difference between day trading and actually, being investing in the stock market, long term? What is the difference between the two?
Oh, it's night and day. Essentially, what you're trying to do is earn an income. And by doing, either trading futures, options, stocks, whatever it may be, the goal is to make an income to make a living. Versus passive investing is more building wealth long term and really allowing your assets to appreciate with the individual securities that you hold. So one is more hands-on and the other one is more, let the economy, let the market, let your strategy do the work.
So I guess one versus the other, I think, would you say day trading and is more riskier than passive investing, or would you say that it's the same?
I would say it depends on what your goal is. If again, there's people out there that love to day trade. There's nothing wrong with it. As long as you're trading a security that you're comfortable with, whether that's futures, just individual stocks or options, that's perfectly fine. But I think the biggest mistake that most, amateurs make is that they're there just to get rich quick, which is not the reality at all. You need to have a strategy. You need to have a plan. You need to assess your risk, and you have to understand how much money you're willing to lose to earn that potential return. So I think that's the biggest mistake.
And that was your realization once you started learning about the difference between both of them.
Oh, yeah. I was definitely on board. I wanted to get rich quick, but that's just not the reality.
Yeah. So now that you know all of this, what is the easiest way to get started with investing?
I would say the easiest way is through something that's already been established for you. So majority of us work for an employer that offers a 401k or 403b or TSP or whatever it may be. I would say start there, because that's going to get you used to, the process of buying and selling individual securities. Obviously, you also have to understand what the goal is for that account. So whatever it is, like I mentioned, day trading is more for income. So the transactions are very fast. They're happening every day, every week, versus something like a retirement account. They don't have to happen as often, because the goal is to not touch this money until you retire, which could be, 20, 30, 40, 50 years from now.
Depending on where they are.
Correct. Yeah.
In their timeline. And so I guess my question, if someone does have a 401k, does have an employer, what's the best way to what they should do? Because obviously it's one thing to have an account and it's another thing to be actually invested, right?
Yeah,
because you can contribute your money, have a certain amount of money be sent from your paycheck, but then you still have to go into your account and invest the funds.
Correct.
And sometimes a lot of people don't know that, but that's the second part, the most important part, I would say.
Yeah, definitely. And I guess just to give you a backstory, before, in the late 90s, things started to change in the United States, where less companies were offering pensions. Now it's very, very minimal. Usually the only ones that still do is governments. So the big aha is that the 401k was pretty much passing the burden of investing to you, because now the employer doesn't have to worry about growing your money so that you can retire comfortably. Now it's up to you, the individual, to be prudent and invest your money wisely so that you can have enough for retirement. So just to understand that. So now that's why people have to understand how to invest, because now it's up to them to make sure that they're investing their 401k or 403b, whatever it may be, wisely, and so that they achieve the goal that they want to achieve, which is, I want to have X amount by the time I reach 65 years old, whatever it may be.
Yeah, and I think most people don't realize it's a long-term strategy. It's not a short-term strategy. But there is some people out there that don't really want to. There's a movement, I like the FIRE movement, which it talks about let's retire earlier than that. I don't want to wait till I'm 59 and a half. I don't want to wait till I'm 65 to start living life.
Right.
And so what advice would you have for those people that want to start investing but don't necessarily feel attracted to the 401k world?
Well, I guess first I'll cover the FIRE movement. I think people have to understand that, there's a difference between financial independence and financial freedom. And I think people that want to retire before 59 and a half, which is amazing, good for you, but that's financial independence. That means that you still need to find ways to make money, whether it's through rentals or your investments, whatever it may be. You still got to figure out how to make a living, because you still need to live, right? And so that's the big caveat that a lot of people don't understand. So it's definitely doable, but it's a lot of sacrifice. So you have to really sacrifice a lot to make sure that you're not giving in to instant gratification today so that you can have that lifestyle in the future. So now let's say you don't want to invest in a retirement account because, you want to use that money today. Well, there's options out there. The most common is a regular brokerage account, a taxable account that a lot of these big custodians and firms offer. The caveat to that, though, is you are taxed on all the capital gains that you realize year over year. So you don't have the same tax savings as you would in a retirement account, whether it's a Roth or a pre-tax retirement account. These taxable accounts, you have to pay taxes. So if it's usually short-term capital gains because a lot of people like to buy and then they freak out and then they sell within a year. So that's going to trigger short-term capital gains. If you want long-term capital gains, you got to hold that investment for more than a year.
So obviously there's just more of a tax implication when it comes to investing with a retirement account versus with a brokerage account.
Yeah.
Like you were saying, where it's a taxable account where you get taxed when you do sell your investments. And some people don't realize that, what the difference between the two as they, want to start their investing journey. But I guess my biggest question is, like, let's say someone, whether they decide to go the brokerage route and open that individual account or trust account, or someone who decides to start investing in their 401k, what should they be investing into as a beginner investor?
Yeah, as a beginner, I mean, it goes back to what is the goal? The goal should lead everything along with your risk tolerance. Most people don't even know how much risk they're willing to take. And a big reasoning and a big, movement right now is crypto. Crypto is taking over a lot of people's minds, and that's great. But at the end of the day, you got to understand, are you okay losing all that money because it is not an actual security? There's no tangible value of that crypto. So what's going to happen? I have no idea, so I think as long as you're okay investing in that, or whatever you invest in crypto is money that you're okay losing should it get lost.
Yeah.
You have to have your comfort zone. So that's what a risk tolerance questionnaire will help you with. It'll help you understand, am I okay losing this much money? If this is all your savings, then I would not recommend that.
Yeah.
If it's something small, then okay. It's your choice. At the end of the day, it's your money. So something simple to start with would definitely be things like exchange traded funds, ETFs. They're super easy, low cost, and they help you do what a lot of portfolios always lack, and that's diversification. ETFs are pretty much essentially a bucket of various, it could be equities or debt securities or even commodities like gold and oil. It's just different holdings in these buckets that allow you to diversify your money a lot better throughout different industries and sectors, so that when the economy does tank, it helps balance the losses a little bit more.
Yeah, so I think the biggest thing is, like, with crypto, and I know that that's like a big hype right now. And a lot of people, they're like, yes, I want to get into the crypto. But I think the way, and I think you and I agree, I see it as gambling money, like, because it's also like working in wealth management, like it's not very regulated. So there's just like a lot of speculation with that. But versus with ETFs and all these other types of investments, it's a lot more heavily regulated. That's why.
Well, believe it or not, the SEC and a few firms actually just launched a couple crypto ETFs.
Oh, okay.
Again, how are they valuing these ETFs? We really don't know, because these cryptos don't have a tangible value. Like, let's say you have a bar of gold, or you own stock in a gold mining company. You know how much that's worth because there's something tangible behind it.
Right.
Crypto is, I say it's $100,000 today, and then somebody says it's 90 tomorrow. That's not there's no actual value there. It's just all very speculative. So that's what makes it dangerous.
Okay, that makes sense. And I think going back to the ETFs, so I mean, with your investment philosophy, being more like towards ETFs, what would be some recommendations of like how to figure out like what strategy to use, like which funds to buy, or um, where are you in the like spectrum? Like, are you someone who's like more conservative or someone who's like more aggressive and wants growth? Like, how do you pick which strategy to go with?
Yeah, and I think it goes back to, three things. What is the goal of this investment or the account that you're investing in? What is your risk tolerance? And what is the timeline that you will need this money?
Mm.
Because again, if you're young like us, we can say, oh, we're super aggressive and we're saving this money to, buy a car in the next year. It does not make any sense for us to invest it super aggressively if we're going to need it in a year.
Yeah.
Because for all we know, the market can tank tomorrow, and then there goes our potential new car or
Yeah.
whatever it was being used for. So you have to be prudent in the way you decide these things. So I would say focus on your risk tolerance, your time horizon, and what the overall goal is for that money.
Overall, if you can start all over again, like if you were back to the beginning stages of your investing journey, what would be like the three things that you would do right away?
Oh man, that's a great one. Well, for those of you who don't know, I was in the Marine Corps for about 8 years. I definitely regret never saving a penny into my thrift savings plan. I think for me, I would definitely put as much money as I can, especially when I was still single and just, I thought I was king of the world. I was earning like $800 every 2 weeks and I thought I was rich. Like I would have saved as much money as I could away and invested it. So I was definitely invest in my retirement a lot sooner. Um, you said three things.
Yes.
I wouldn't. I guess my second thing that I would change was change my mentality about money. Um, because obviously we live in a consumer environment where we're being fed every day that you got to buy this, you got to do this, you got to do that. You have to stay true to what you believe. And if buying new clothes and buying new cars is your thing, so be it. But at the end of the day, I wish I would have been more prudent in, hey, this is my future, this is my money. I want to take that great vacation to Fiji one day, so I need to start saving now.
Yeah.
So I would definitely change the way I think about money. And yeah, I mean, I guess the other thing is just I'm glad I started investing in futures contracts because that's what piqued my interest in the industry as a whole, because I did not know how big this industry was. I thought selling insurance was like, that was it. But there's so much more that goes to someone's financial plan and financial life that um, that I feel like I wish I would have known more a lot sooner about the actual industry and everything that's available to us. Because especially people like us that don't come from money, all we know is what we've been taught. And there's so many more investments, there's so many more vehicles, there's so many more strategies out there to really start building your wealth that I wish I would have been more curious to learn that sooner, or somebody would have taken the time to teach me that.
Yeah, definitely. I think I could agree to that. I mean, we both come from very similar backgrounds, and like none of this was passed down. And knowing what we know now, like it can be a really game changer. And so that's
Hmm.
why we titled this, podcast "Building Wealth from Scratch," because that's what we feel like we're both doing together. It's like we're building wealth from scratch because a lot of these concepts were not taught to us, and it's nobody's fault. It's just the way, things
Hmm.
was, unfolded in our lives. And so we're the ones really trying to make a difference for the future generations that, hopefully we're, building like generational wealth for our future kids. And so that's just one of the reasons why we're so passionate about wealth. And, and I think because of that, sometimes a lot of us can be like, I wish I would have known this, I wish I would have known that. But I don't think it's too late to ever start building wealth. I think it's always like, you can always start at some point, and it's never too late. Because I know a lot of people always get discouraged. And especially now that, we're not in our early 20s, like I think we have like a different perspective about money.
Yeah, definitely. And I think it's money is a tool. And that's what I always start every client conversation with. It's a tool.
Mm-hmm.
It's not going to make you a good person. It's not going to make you a bad person. That's up to you to decide. But it's a tool that will help you do the good things and the bad things that you want to do. So it's up to you to decide how you want to distribute your money. And if it's for good, great. I'm all aboard, because I think at the end of the day, if we're not helping each other, and if you're not learning and you're not growing, it's going to be very, very hard to really do anything in life, not just build wealth.
Yeah, no, it really will. So a lot of the concepts that you learn as you're building wealth, it really does translate to life. And, just trying to have like discipline, even with just saving money, and even with investing, like consistency is going to win, trying to time the market. And,
Oh, yeah.
And yeah, and I think we should even like dive into that, because what is it? What are your thoughts? Like, I think with day trading, you're kind of trying to time what the prediction of what's going to happen, versus with passive investing, it's like you're just consistently doing it over and over again, so that that's going to outweigh trying to time the market. So
Yeah, definitely. And to be honest with you, it's less stress.
yeah, you just like let it.
When you're like, I need to make this money, if not, it's like, no, it's so much easier. And then not only that, but if you do, you take advantage of dollar cost averaging, you're gonna save money in the long run. And it's much less stress than trying to do it all by yourself.
Right. Yeah. So I think this was good. I feel like this was a good way of like introducing investing. And I think definitely, like through your journey, through my journey, we've learned a lot. But what would you say, I guess, like you would want to end this with, like for the first time, like wealth builders, like what are some key things that they can start doing like right away if they're really interested in, starting?
Yeah, well, I would definitely say that you're not alone. We were right there with you. We still are. We're still building. We're accumulating assets, so you're not alone. And that's the reason why we started this business, this firm, because we knew that there's so many people like us that don't have that help, that not only don't get the help, but they don't get the fiduciary help, which is what I truly admire about our business, is that we have to do everything in our power to do what's right for you and your best interest. And I would say definitely, if you want to just get started, I think we already covered that, ETFs and things like that. We will add a risk assessment questionnaire at the bottom of the comment section. So if you want to definitely get started, at least get a sense of how much risk you're willing to take, that's definitely a good starting point. That way you have an idea of what asset class and asset allocation you should start with based on your risk tolerance.
Yeah, I think that pretty much concludes this first episode.
Yeah, well, thank you so much. I forgot my notes. Thank you. Thank you for listening. I hope you found some value in this. If you did, please, like, comment, or subscribe. We will be doing these monthly. So if you have any future questions that you would like us to answer, please put them in the comment section, and we will be sure to answer them on future episodes.
Yeah. And
all right. Thank you.
Thank you.
Thank you so much for joining us. Make sure to subscribe to our show so you never miss an episode. If you took anything away from our show, you can help us grow by liking and sharing this podcast episode. Be sure to follow us on Instagram at Wealth with Jerry and at It's Bianca Ariana. If you are ready to transform your financial journey, I encourage you to visit confianzawealth.com to get more information and schedule your complimentary call.
Confianza Wealth Management is a registered investment advisor in the state of California. Advisory services are only offered to clients or prospective clients where Confianza Wealth Management and its representatives are properly registered or exempt from registration. This video is for informational purposes only and does not constitute individualized advice or a guarantee that you will achieve a desired result. You should consult with an appropriate tax and/or financial advisor for advice specific to your situation. All expressions of opinion reflect the judgment of the host/interviewee on the date of the program and are subject to change. The information presented is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or a solicitation of an offer to buy or sell the investments mentioned. A professional advisor should be consulted before implementing any of the strategies discussed. Investments involve varying degrees of risk, and there can be no assurance that any specific investment or strategy will be suitable or profitable for a client's portfolio. All investment strategies can result in profit or loss.